Hi everyone. We've dealt with the concepts under Ind AS 102, which is share-based payments. It's time to apply those concepts with the help of several questions to test our knowledge on this particular topic. We are given this scenario. It says that Beta Limited has announced a share option scheme to 500 employees. The scheme required the employees to remain in service for 2 years with the organization. Below is the number of employees to whom the options are expected to vest at the end of each year. The end of year one, it's expected 95% people would remain in service up to the end of year two. And during the year two, it is expected that 90% of employees, or rather, it is understood that 90% of employees actually remain in service at the end of year two. Each employee is given 100 options, and the fair value of the share option or date of grant is 175 rupees per option. The requirement is what is the amount of expense to be recognized by Beta in both years. Now, friends, you will need to remember here, of course, when you look at any question on share-based payment, there are a few points that you want to remind yourself on. One is, of course, you look at the fair value on the date of grant. That is given to us at 175 rupees. Okay. You look at, of course, the number of options for each employee. That is also given to us, which is 100 options. Right? We're also looking at, of course, the calculation of the vesting period. Essentially, this statement suggests that the employees should remain with the organization for 2 years' time. So that means that my vesting period has to be 2 years. All right. Now, when you have all this information, you just need to assess whether the conditions are market-related conditions or service conditions or performance conditions, right? Now, essentially in this scenario, there is no reference with respect to the market conditions, right? Wherein we say that you're looking at the share price of the entity, you're looking at the market capitalization or the value of the company. So there is no parameter around that. The only requirement is the service condition or the performance condition as far as this scenario is concerned. So how do you deal with that? How do you assess this part? Okay. Also, you want to remember here is that since there's a share option, it simply means that the option is, or the share-based payment is an example of equity settled share-based payment, right? So these are the things that you want to take a note of when you are doing any questions with respect to the calculation of or measurement of, let's say, these share-based payments in such cases, right? Now, what we need to remember, if the vesting period is 2 years, the concept suggests that the costs need to be charged over the vesting period, right? Now, essentially, it depends on the number of employees expected to stay, right? It depends on the number of employees who are expected to serve or meet that vesting period or meet the vesting conditions. Okay. So if I were to bring that on a timeline, we are saying that this is today, which is year 0, this is year 1, and this is year 2. Okay. Now, we have 500 employees as on date. So let's place those numbers here for understanding. Okay. At the end of year 1, which is this time period, okay, we are expecting that in total 95% employees would stay. Okay, that is an important calculation for us. We are saying that 95% of 500 people would stay with the company until the year 2, which is the vesting period again. Okay, so when you say that you are expecting that 95% people would stay, your cost calculation would be based on that particular number. Okay, so what you're doing is basically you're saying that my total cost at the end of year one, my total cost, it's important to understand my total cost for the whole 2 years, for the entire 2 years, as expected at the end of year one is going to be the number of employees expected to stay, the number of options per employee, and the value of each option. It's a fair value of each option when it was granted to that employee. Okay. Now, this cost essentially represents the cost for 2 years. So essentially, when you look at this element, when you calculate this number, you need to identify, you need to measure it, of course, what is the cost that is going to be for only year one. We say the cost will be taken at the number of employees expected to stay, number of options per employee, value of the option, and of course, we look at the amount as divided by 1/2, because of the fact that we need to calculate this cost for the first year, first of all. That's a requirement of the question as well, which is saying that what is the amount of expenses to be recognized by Beta Limited in both the years, which is each of the years, of course. All right. So let's do this calculation. We're given 95% into 500. Let's do this. 95% into 500 into 175 into 100 divided by 2. Now this comes at 41,56,250. So that comes to be 41,56,250. The double would have been the cost for the 2 years, right? The total cost would have been twice the amount, which is, for example, if I were to double this simply, we would have said that the total cost would have been 83,12,500, right? Just the half of the value is taken because we are calculating the cost up to the end of year one. Okay. Now, when you look at the year end 2, which is the completion of the vesting period, we are now provided that actually speaking, only 90% of the employees have stayed, which now gives me the same parameter of the calculation, which is, if I were to look at it, my total cost would be 90% into the 500 employees into 175, which is the value of the option, and the number of options, which are 100. Now this number comes at 78 lakhs 75,000. Now this is my total cost. This is my total cost for 2 years, right? 78 lakh 75,000. But I have already charged in my year one, basis my estimate of the number of employees, I had already charged my cost for year one at 41 lakh 56,250. So the differential, which is calculated as 78,75,000, which is 78 lakh 75,000 minus 41 lakh 56,250, the amount comes at 37 lakhs 18,750. So rupees 37 lakh 18,750 becomes the cost for year 2. All right. So again, just to revisit quickly, we are saying identify what is the fair value of the option on the date of grant. How many number of people or number of options per employer available, the vesting period, whether the conditions are market conditions or service conditions, that is the performance conditions. And then you look at, of course, whether the category of the share-based payment is a cash settled or an equity settled share-based payment. Okay. And of course, we are charging those costs over the vesting period over the 2 years in the given scenario. The first year's calculation is done at 95% of the number of people expected to stay into number of options per employee into the fair value of the option or rate of grant. But of course, for the half period, the vesting period is 2 years. Year one is going to be the half the cost, which is 41,56,250. For the second year, we take a cumulative value, which comes at 90% of employees exercising that option, which means 90% into 500 multiplied by, again, we keep that 175 intact. Okay, that does not change as far as equity settled share-based payments are concerned, right? Into the number of employees. This gives my total cost up to year 2 at 78,75,000. I reduced the cost of year 1, which gives me the cost of year 2 at 37,18,750 rupees. All right, let's have a look at the formal solution. It's purely about the calculations. It says that in year 1, options to vest is 95%. We measured that. We've already done those calculations for the half year, which is 41,56,250. In the year 2, it's 90% people who are going to exercise the option. So you calculate the full cost up to year 2 end and minus, this is year 1 cost. Okay, that gives you the balancing amount of 37,18,750. All right, let's have a look at this scenario. It says that Strong Limited has announced an incentive plan where it has issued 100 shares to each of the 200 employees. The scheme requires the employees to be in service for 2 years with the organization, and the settlement has to be done in cash. Now, this is a different scenario. You're not issuing shares, right? You're going to give cash to the employees. Below mentioned are the fair values of the options on the various dates. On the date of grant, it is 100 rupees. At the end of year 1, it is 90 rupees. At the end of year 2, it is 95 rupees. The question is, what is the amount of expense to be recognized by Strong Limited in both the years? Again, we follow the approach, stepwise approach. We look at, of course, what number of options per employee, okay, that is provided to us, which is 100. Okay, let's even look at number of employees otherwise, which is 200. We are given the vesting period, which is 2 years, right? Fair value of the option on grant date, that is also provided, which is 100 rupees. Okay, so we have captured all this information. Now, importantly, okay, what you want to remember here is that the share-based payment, the category or the type of share-based payment is cash settled share-based payment. Right? Now, what do you want to remember in this scenario? What you want to remember in this scenario is the moment it's a cash settled share-based payment, the fair value of the option at the date of or at the date of grant or the grant date is not relevant, right? In case of a share-based payment, which is a cash settled share-based payment, we do not consider for the measurement purposes the fair value of the option on the date of grant. We will keep on remeasuring that liability, right? Because it's a cash. So the liability has to be remeasured at the end of each reporting date, right? You want to remember that. In case of a cash settled share-based payment, the fair value of the option on the date of grant is not relevant. For calculation purposes, we need to remeasure that value of the liability at the end of each reporting date. All right. Now, if I were to use that, it means that for me, the relevant values are going to be rupees 90 and rupees 95 respectively for the year 1 and year 2. Okay. So the question's requirement, as we understand, what is the amount of expense to be recognized by Strong Limited in both the years? How do we now calculate that? We again build that timeline here. Okay. Let's say this is year 0, this is year 1, and this is year 2. All right. I don't have to worry about year 0, but I would make an assessment how many number of people are expected to stay and what is the value of that cash settled share-based, cash settled share-based payment at the end of the year 1. Okay. Now, we are not provided any information about the percentage of employees that is missing. right? So we can safely assume that all these 200 employees are expected to stay in this scenario. Okay, so how do I calculate this value? We are saying now my number of employees, which is 200, my number of options, which is 100, the value of the option, which is given to me at 90. So this is my total cost. Okay, this is my total cost for 2 years. Total cost for 2 years, which means that my year one cost has to be 200 into 100 into 90 into 1 by 2. That would be 1, 4, 5 zeros, 1, 8, 18 lakh. That becomes, of course, 9 lakh rupees. So my year one cost has to be 9 lakh rupees. All right, I've just done the calculation verbally, so I don't have to worry about that. All right, now second part, when you go to the year two, my total cost will be 200 into 100 into 95. So I again calculate the total cost for 2 years, right? Now, which comes at, of course, 200 into 195 is 19 lakh. This is my cost up to the, or as on, at the end of year two for the year one and year two together. But I have already charged a cost of 9 lakh rupees, right? My year one cost is 9 lakh rupees, which is charged already in the books, which means that my cost for year two has to be 19 lakhs minus 9 lakh, making it 10 lakh rupees. Okay, so that's the way you start looking at it. You want to remember that in case of cash settled share-based payments, the liability is remeasured at the end of each reporting date. Okay, the liability is remeasured at the end of each reporting date, and accordingly, the costs are determined on the basis of that measurement criteria. All right, let's have a look at the formal solution in this case. Of course, we have provided the year one. Half of the options would be vested, which simply means that 200 employees into 100 into 90, which is the fair value of that particular option. I will take half of the value, which comes at 9 lakh rupees. At the end of year two, my total cost would have been 200 into 100 into 95, which makes it, of course, 19 lakhs. I will reduce 9 lakh rupees out of that, which means that my cost for year two is going to be 10 lakh rupees. All right. That's what we say. The liability will be remeasured at each reporting date, and the fair value will be used for the purposes of expenses recognition. All right. Let's have a look at this particular question. It says that XYZ Limited is a subsidiary of ABC Limited. Okay. The management has announced a group share-based payment plan where ABC will issue its shares to the employees of XYZ. There are no vesting conditions to be met. Hence, the scheme vests immediately. Other details of the scheme are as below. Number of employees of XYZ is 200. The fair value of these shares on the grant date is 90. Number of options to each of the employees is 50. The question says, what are the journal entries to be passed in the books of both ABC and XYZ? Right? Now, importantly, what you want to remember is when you look at group share-based payment plans, like in the given case, there's a parent which is issuing shares to the employees of the subsidiary, right? Now think about it like what's happening, right? If we go back to the concept, the employees are working in this company, right? So essentially, the benefit of service is available with, or is given to, or is provided to the subsidiary, All right. So automatically we say that the related costs of share-based payments need to be also charged in the books of the subsidiary. Okay. What are we saying is that since the employees are serving the subsidiary and the subsidiary is receiving the benefit of their service, so the associated cost of those share-based payment plans should also be charged in the books of the subsidiary, right? It simply means in the books of the parent in this scenario, you cannot book any cost. All right. So if I were to book the cost of those share-based payments in the books of subsidiary, in our case, of course, the company's name is XYZ, right? So I may say in the books of the subsidiary, I would debit those costs, right? And we can obviously measure the amount, which is 200 into 90 into 50. Okay, so 200 into 90 into 50. We are taking the entire cost because the options are vesting immediately. There's no delay in that. Okay, and this gives me the total amount would be 1, 2, 3, 4, 9 lakh rupees here, right? Credit what? We are saying that because the expenses coming in the books of the subsidiary, the expenses coming because there is an infusion by the parent company. The parent is offering something back to, of course, XYZ Limited. We'll come to that in a minute in terms of what would that mean, right? So when I look at that particular amount being provided by the parent to the subsidiary, we would say in the books of the parent, which is ABC Limited, we say that there is an investment in XYZ, right? To the extent of that 9 lakh rupees, right? Of course, since the shares in parent company are issued, so we may also say that equity, we don't want to use the word shares or capital, but we simply want to use equity, and that may be explained as shares to be issued. So that would be 9 lakh rupees, right? So in the books of the parent company, we are saying there is an investment made by ABC Limited in XYZ. So that's where this accounting entry is, of course, built. Now, from the XYZ's perspective, while the expense has been granted, automatically, we would say this notional value, this money is coming from, of course, ABC Limited itself, right? And that is where you start looking at that the expense recognition is happening in the books of the subsidiary, and in the books of the parent, it is reflected through as an investment to be made in the subsidiary itself. All right. So when you look at the formal solution in this case, you can simply say that investment in XYZ to equity, which is shares to be issued in the books of ABC, sorry, that's what it was. In the books of XYZ, it is a remuneration expense or an employee cost to ABC Limited, or the capital infusion by ABC from the parent's perspective in the books of course, the subsidiary itself. All right. Now, we have provided this question where it says that Gamma Limited, a shoe manufacturing company, has entered into a contract with the supplier PQR to purchase 50 kgs of a material A to be settled in cash for an amount equal to 20 shares of Gamma Limited. However, Gamma Limited has an option to settle the contract at any point in time by paying an amount equal to the current share price of 20 shares minus the market value. Now, Gamma Limited does not intend to take the physical delivery of material A. The question's requirement is, how should Gamma Limited evaluate the transaction under Ind AS 102? Now, you want to remember here, while the first paragraph suggests that this is an example of a cash settled share-based payment, but the second paragraph does not indicate so. You're looking at a net settlement. There's no physical delivery intended. Okay, it simply means you are probably referring to a derivative transaction, right? And a derivative transaction would not fall within the scope of the standard, which is share-based payment. It is rather an example of financial instruments, wherein we look at, of course, Ind AS 109. So all such kind of transactions where there is no settlement taking place, there is no physical delivery taking place, but it is essentially met with, or let's say, settled in form of a net settlement. You either would pay or receive something as a differential amount, right? In such cases, Ind AS 102 is not attractive. It is not a scope of Ind AS 102, but it lies within the scope of course, Ind AS 109, that is financial instruments. All right. So tricky question. The examiner probably expects you to be thinking on the lines of share-based payments. Don't get carried away by that. You need to remember the scoping aspects in this case. All right. Let's have a look at the formal solution. It says that any non-financial item which an entity has an option to settle on a net basis that is not covered by 102, but of course it is covered by Ind AS 109, that is financial instruments. All right. Let's have a look at this question. It says that Sigma Limited has entered into an agreement to acquire the business of Omega Limited on 31st of December 2020. Omega Limited has an existing share-based payment plan for its employees, which has a vesting period of 3 years. Of this 3 years, at the date of acquisition, 2 years have already elapsed. Now, as per the acquisition agreement, Sigma Limited has agreed to replace the existing plan for the employees post the business combination. Below mentions are the details of the plans. Acquisition date fair value of the existing plan, which is 450 rupees. Number of years to vest post acquisition is 1 year. Fair value of the replaced plan is rupees 500. The question says, determine the share-based payment values to be recognized by Sigma Limited as per Ind AS 102. Now, in this question, what you like to remember is that there is an overall vesting period of 3 years and 2 years are already gone by. That's the first point that you would like to kind of remind yourself. Of course, the number of years to vest post acquisition is 1 year. Okay, so how do you look at the value is important. All right, so we are saying that if the fair value of the existing plan, right, on acquisition date is 450 rupees. All right, so we essentially mean to say that out of this 450, there is a split of the cost. For example, let's say for a period of 2 years as pre-acquisition, and for the remaining year, of course, of post-acquisition. So we are saying that now, ideally speaking, this cost would have been charged already, and this is one cost that still needs to be charged, let's say, in the system. That's one part of the discussion that we want to do. Okay. The other part which is critical is that we are replacing this with the new plan. The value of the new plan is given at 500 versus the value of the plan which was already in place is 450, which means that if you look at this, there's an incremental benefit available to the employees to the extent of 50, which is basically 500 minus 450. Okay, so essentially what we are saying is that this 300, which is a pre-acquisition benefit, would be measured under the accounting for business combinations because there is an acquisition, of course. And as far as the share-based payment is concerned, the accounting shall be done for the remaining 150. All right. So this is covered under Ind AS 102. So the total cost that needs to be accounted for in the books is the remaining cost to be still charged over the remaining vesting period, right? This is still, due to be charged right? So this due to be charged plus the incremental benefit which is available to the employees because the plan has been replaced, right? So we're saying that the total cost of 200 shall be accounted for in the financial statement. And that is where you start looking at the recognition under Ind AS 102 in the books of Sigma Limited. All right. You would need to remember that is a replacement. So automatically the 500 minus 450 becomes relevant. It's important. Likewise, out of this 450, there is something which already has been charged so far in the books of Omega Limited from the perspective of the accounting under the share-based payment. So that would be taken care of. And from for the remaining period of 1 year, of course, the portion of 150, the pro rata value of that 450 would be also a part of the cost in the books of Sigma Limited. All right. Let's have a look at the formal solution. We are provided that the vesting period pre-acquisition is 2 years. The vesting period post-acquisition is 1 year. The total fair value on the date of acquisition is 450. So effectively, from the perspective of the business combination, 300 would already have been considered. Okay. And as far as the Ind AS 102, that's a requirement of the question, of course. So that would be, of course, taken into consideration. This 150 will be taken at the value. The fair value of the replacement award is 450, so 500, my bad. So the remaining amount 50 will be taken over and above, which means the total cost of 200 is something that needs to be recognized in the books of Sigma Limited under this arrangement of share-based payments. All right. We are now provided this scenario. It says that Kappa Limited has announced an employee share-based payment plan. The details of the plan is provided below. The number of employees are 200. The fair value on the date of grant is 30 rupees. There is a service condition till the below market condition is fulfilled. By the way, you have to be in service until the market condition has been achieved. So there's a combination of both service and market condition, right? The market condition suggests that the equity share price of Kappa should reach at least 100 rupees. All right. Also, it's mentioned Kappa Limited's expectation of the meeting the target prices 4 years, right? The question is, what should be the expense to be recognized by Kappa Limited in each year for the below mentioned scenarios? Scenario 1 is the market condition is fulfilled in 3 years. Scenario 2 is market condition is fulfilled in 5 years of time, right? Now, think about it like this. We are saying if there is a market condition, we do not change the accounting for the costs under the share-based payments, right? This value of 30 rupees takes into consideration that market condition, right? That is what Kappa is thinking, that this would be, let's say, the share price of 100 rupees will be achieved in 4 years. That is where this 30 rupees is taking everything into consideration, right? Of course, in that sense, if the market condition is not filled in 4 years of time, that's the second scenario. It does not make any difference in your account. Okay, which means, by the way, and I'm intentionally looking at this scenario first, if the condition is not met in 4 years of time, although Kappa had planned for that, Kappa anticipated that it would be completed in 4 years of time, it does not change anything in accounting, even if it is not met in 4 years, but it's getting met in 5 years. It could be 6 years, 10 years, whatever. Does not change anything, right? So the entire cost would be spread in the 4 years duration. All right. However, in the first scenario, as it is fulfilled in 3 years of time, it results into something called as charging the cost immediately for the remaining period, something called as an acceleration of the costs when you look at such kind of a scenario, right? What we're trying to say is that in the year 1 and 2, you continue to charge the costs, assuming that the condition would be met in 4 years of time. But in the year 3, if the condition is met, it simply means that Now the employees are eligible to get those options because they become vested the moment this target price is met. So any remaining costs which are still to be vested, which are yet to be vested, shall be charged in the financial statements immediately. Okay, so using the numbers around it, we are given, of course, the number of employees of 200, and the value of the grant is value of the option on the date of grant is 30 rupees. It simply means the total cost is 200 into 30, which is 6,000. Okay. Now, essentially, in the scenario one, the way I would want to account for my costs, since my question is asking me what are the costs to be charged at the end of each year. In the year one, my cost to be charged should be 6,000 into 1 by 4. This is also, I'm not even reaching to year 4. Automatically, it is getting vested at the end of year 3 itself, which means that if my total costs which have been accounted for is 3,000, okay, simply means that out of the remaining cost of 3,000, I will be charging those costs entirely. So of the total cost of 6,000, I've already accounted for 3,000, which is for year 1 and year 2 respective, I mean in totality, right? So the remaining amount of 3,000 should be accelerated as an immediate, okay? The event that the vesting vesting condition is met, it triggers the recognition of the costs immediately in the statement of profit or loss. All right. The moment I look at my second scenario, where I'm expecting that when the market condition is getting met in the year 5, it has no impact whatsoever on the accounting that I intend to do, considering my initial estimate or assessment of when that price would be met, which means that I'm charging these costs evenly at the end of each year, right? So this is the way, this is the scheduling or the charting of my cost to be charged in the statement of profit or loss if the market conditions are actually met after year 4, which could be year 5 or even subsequent periods in our example. All right, let's have a look at the formal solution. It says that market conditions shall take into account when estimating the fair value of the option on the date of grant. We have taken those parts. In case of service condition, it is considered in estimating the number of options to be exercised. That's simply the way we do the accounting throughout. All right. If the accelerated vesting, however, if it takes longer, then the original vesting period shall be followed. And that's what we have done. As far as my accounting in the first scenario is concerned, you're charging 1,500 each in the years 1 and 2 respectively. But as far as year 3 is concerned, you recognize the entire cost, entire remaining cost immediately once that target price is met. As far as the second scenario is concerned, we are evenly charging this cost. Assessment was made by, of course, Kappa Limited indication that the target price is expected to be met in 4 years of time. In the year 5, the cost will be simply taken at. All right. Thank you very much.